All right, guys. There we go. Let me put this camera on. It's been a minute since I've done one of these 5 minute-ish Fridays. Just been extremely busy over the past couple months. Actually, since Christmas. So let me go ahead and just kind of get into it. This is from. I received a couple of tapes on these HECM mortgages, these high equity conversion mortgages, and I don't see a lot of information out there. So I figured I'll just do a topic on it. Hang on a second. Let me do the PowerPoint. And all right. So, yep, I see it. So, here's a case study on why this reverse mortgage is not a claim play. So, I'll get into it a little bit on the differences on these HECMs, these reverse mortgages. There's really two buckets, but before I do that, let me move over here. Before I do that, I would just want to do a level set. So what is this HECM? HECM. It's just a excuse me. It's a home equity conversion mortgage. It's pronounced HECM. It's just a reverse mortgage for homeowners over 62 plus. No monthly payments. The loan balance grows over time, and it's backed by FHA insurance. Simple takeaway on these: this is not a normal note. So if you're pricing these like a normal note, you will get burnt. So just be careful. That's the whole point of me doing this. So why does this actually confuse investors? Most investors think no equity equals a bad deal, but HECMs can work even with when they're actually underwater. Why? Because of because of FHA insurance. And really, the people buy these base filing a claim with FHA. I buy them because of the equity, and I'll talk a little bit about that. So basically there's two buckets that every HECM actually falls into. You have equity back and claim back. So the equity back is meaning that you have equity in the property from what that like the note that's outstanding versus what the property is worth. So you have equity 50, 60, 70, like 92% equity. And then the claim back is they're just 100% upside down. There is no equity in this property. And so the play on this is to file these FHA claims. And there's just a lot of paperwork. There's a lot of, the stars got to align, in my opinion, for these things to go through. And you really have to know what you're looking at in order to make sure that it meets all these criteria. Because if it's not, you think you're going to get 100% of the claim, they could just flat out deny it, or you can, get 50%, 60%. So whatever value that you thought, whatever profit you thought you were going to make, it can come back to bite you in the ass if these claims aren't properly set up. And that's why I always encourage when you're buying these, if you're strictly buying them from a claim base, please 100% use an attorney, because if you don't, you will 100% get burned. So everything starts there. My first principle that I underwrite reverse mortgages strictly as equity deals. I do not do claim base. If the equity does not work, I 100% walk on this. I do not rely on insurance to save the deal. In my opinion, it is not worth it. So here's a tape that I got. It had 19 HECM loans on there, and one or two things. They were outside my state, or I'm sorry, my buy box, basically the state that I'm looking to buy these in. And the other thing is they were upside down, meaning there was no loan to value, and severely upside down. And like I said, I do not buy these on an insurance play. I strictly buy these on an equity play, meaning I need to figure out what all my all-in numbers, the profit and everything that I want to make, and then that's where your after repair values. And I got an example of it. That's where your after repair values come into play, and then that's what you make your offer on, right? So this is the one that I was doing a little bit of research on. This Lima, Ohio. This is just right up the street from me, and so I just initially start looking into it, trying to validate that it is worth 135. Honestly, it's worth about 130 after it's all fixed up. And you can see that the loan to value is 84%. Then you have the as is values. It is the way that it's sitting right now. It's 45. It's way high in my opinion, and I'll show you show you the screenshots on this deal. So here's the actual deal in Lima, Ohio. You can see, all the windows need to be replaced and needs a new roof. I mean, it's just it's in pretty bad shape, and I can just only imagine that all the copper's gone and everything that's in there. So here's the deal snapshot. It's in Lima. It's a HECM. It's been vacant since 2018. Yes, vacant since 2018. The estimated total debt on this property is $114,041. The after repair value is 135 is what I used. The as is value is 45,000. The equity reality as is value is 45,000. The debt once again is 114,000. So it's underwater by nearly $70,000, right? So this is not an equity positive asset at payoff. So we must buy at a steep discount. So conservative flip assumption, we can sell this, excuse me, we can resell this at 130,000. So here are some of the estimated costs. Repairs, $55,000. Honestly, I think the 50, and this is just me. When I was rehabbing houses, I had like a rule of thumb that I was using, light, medium, and heavy rehab. So this is just me, just utilizing some rule of thumb to figure out the repairs. Honestly, the repairs may even be higher than what it is. That's where you really need to kind of you need to get eyes on the property, right, in order to walk through it. But in these, if they haven't already taken it back, like the bank, it's not an REO. You can't do that. So you just kind of you have to play it by ear, so to speak, and you have to use high value. So once again, $55,000. Foreclosure costs in Ohio, it's anywhere between 12 to 15. I see people estimating this way low. It's safe to err on the higher value than lower because this ultimately comes out of your profit, right? So holding cost is $9,000. Selling it at 8%. I usually do a little bit more with the agents, just like a little bit of incentive if they can get this once I rehab it, right, and then I offer a little bit of incentive to where if they can sell it within the first 30 days, they get 8% commission, which would be $10,400. So my desired profit on this was estimating to be $25,000. So my total all-in cost would be $111,000. So the max equity offer, or you can call it your MAO, your maximum allowable offer. You have your after repair value 130 minus 110,000. So in order for me to be safe at buying this property, I'm going to have to offer $19,000 on it. You can start there. The range is between 50 to 20. I may just start a little bit lower than the 19 because if you start getting into give me your highest and best, I don't want to just come out of the gate with 19. I may just start at the 15,000 and then work my way up to 19,000 on this. So why am I not pricing this as a claim play? Going after a claim, in my opinion, it's risky because it's a judicial foreclosure timeline. It's vacant since 2018. It accrued compliance risk, unknown HUD deadlines, and servicing and conveyance rules, and paperwork errors can kill the deal. And that's where, once again, because with these FHA claims, these HUDs, they have to meet HUD guidelines. 100% they do. They have a portal that you go in, and if you missed one deadline, it could totally jeopardize this. Or you're like I was saying before, you're thinking you're going to get 100% of this claim, and maybe they only give you 50. Well, now you're upside down in this deal, and it 100% made no sense to buy it at the price that you buy it. So like I said before, if you are going after this is like I was saying, two avenues: equity play or a claim-based play. If you're doing the claim-based play, please have an attorney review that document, those paperworks, even like a HUD specialist. So that way you can make sure that when you get to this, when you do file a claim, that you're secured in this. And for me, equity is controllable, right? I can control that. The the price that I offer based off the after repair values, the sales in that neighborhood, and time on market and things like that. I do not want to rely on the government or some bureaucracy to dictate what can and what cannot be allowed on this claim. So my investment philosophy is I do not bet on bureaucratic processes. Sorry, depending on HUD reimbursement, price off a potential insurance. I price off asset value only. If equity does not protect me, I pass. I walk. I do not. Get in this deal. So some risk summary. Long in this property, it's long vacancy, deferred maintenance, judicial state, thin resale market. If repairs run high, your profits disappear fast. So just please be careful with these deals, and that's why my margin must be high on this particular deal. So the final verdict: this deal here only works if you buy between $15,000 to $20,000. Anything above that shifts that risk to you. No insurance assumptions, equity only on these deals. So and that's the play that I'm going after. I'm strictly concerned about equity deals. I do not do claim-based deals. So lessons from this deal: reverse mortgages do not mean they're safe. Insurance is not a strategy, and equity determines price, and margin protects you. So just remember that, and discipline beats optimism. So if you have any questions about this, please feel free to reach me out. You can send an email to me, Larry at ljhinvestments.com. You can go to my website, ljhinvestments.com. Shoot me a text message or call me, 513-301-1468. Or you can just schedule a time, talkwithlarryhoffman.com. Here, let me go back over here. Talkwithlarryhoffman.com. That actually gets on my Calendarly linked, and then that way you can schedule a time that's convenient for you. 30 minutes, an hour, whatever is convenient for you. That if you have questions about this, or maybe you have questions about putting your lazy assets to work, earning an above average return, just schedule a time with me, and I'll be more than happy to walk you through anything. So with that, I